All right, welcome to Talk Tickers. Today, we're digging into something pretty wild, Six Flags Q4 2025 earnings. The numbers looked, well, kind of like a train wreck on the surface, but the stock actually rallied. So, what's going on here? Let's figure it out.
So this is the big question, right? Their earnings per share, they didn't just miss, they missed by over 200%, a huge miss. But then the stock jumps 8%. How does that even happen? It seems completely backward. Investors were clearly looking at something that wasn't in the headline numbers.
Okay, first up, let's just look at the headline numbers. And really, this was a story of two totally different tales.
So check out this split. On the earnings per share side, it's a big miss. They lost 91 cents a share when Wall Street was only expecting a 28-cent loss. Now, a big chunk of that was what they call a non-cash impairment. Basically, they had to write down the value of some of their assets. But then you look at revenue, and it's a beat. They brought in $650 million, a good 34 million more than expected. So you've got this big loss, but also stronger sales. Super contradictory.
And if you dig a little deeper, it gets even more confusing. Attendance, the number of people actually coming to the parks, was down 13%. Yikes. For a theme park, that is a really big deal.
But wait, here's the other side of that coin. The people who did come, they spent more money, a lot more. Per capita spending shot up by 8%. So fewer people, but each person is spending more on tickets, food, you name it. That tells you the basic business of getting money from customers. It's actually working pretty well.
So what gives? Why did the stock go up with such a mixed bag of results? Well, it turns out investors weren't really trading on this quarter's numbers. They were trading on the story. And that story is all about a new CEO and his plan.
And here he is, John Reilly, the new guy in the corner office. He's been in the theme park business for a long time, and his message to Wall Street was crystal clear. He basically said, look, our parks are fine, our rides are fine, we just haven't been running the business very well. He thinks the big win here isn't some crazy new idea, it's just doing the basics better.
So what's his playbook? It's actually pretty straightforward, no-nonsense stuff. First, he wants to localize decisions. Let the people running the park in, say, Texas, make decisions for the Texas park. Makes sense, right? Second, drive margins. Just focus on being more profitable. Third, be disciplined with money. Only spend it on things that are going to give a good return. And fourth, strengthen the balance sheet, which is just a fancy way of saying pay down debt. Nothing revolutionary here, but it's exactly the kind of steady, disciplined approach that investors were dying to hear.
Okay, so a plan is great, but what does it actually look like in the real world? Well, management was a little cagey on specific numbers for the next year, but they gave us a really clear signal of how they're thinking now. And this is the perfect example of the old way versus the new way. The old management used this broad brush approach. They just straight up canceled all the winter holiday events. Management even admitted on the call that this was a huge mistake, a self-inflicted wound that cost them nearly 500,000 visitors. The new plan, it's all about being smart and specific. They're going to look at each park, one by one, and figure out if a holiday event actually makes money for that specific park. It's moving from a sledgehammer to a scalpel.
Which brings us right back to where we started. Why the big pop in the stock? Well, the market heard this new strategy, and it gave a very clear verdict.
You have to remember, this stock had been absolutely hammered. It was down more than 60% over the last year, while the S&P 500 was up over 14%. So investors were just desperate for a glimmer of hope. That 8% jump on earnings day, that wasn't about the bad numbers from the past. It was a vote of confidence. Investors were saying, we believe in this new CEO, we believe in this new plan, and we're willing to forgive one ugly quarter.
So what's our take? What should we be looking for on the next earnings call? Here at Talk Tickers, we've crunched the numbers and listened to the call, and here's our view.
We're slapping a market perform rating on this one. And what that really means is this is a classic show me story. The plan sounds great. It makes a ton of sense, but a turnaround like this doesn't happen overnight. We're talking multiple years. So while we're optimistic, we're also cautious. They have to prove they can actually do it. Execution is absolutely everything here.
So if you were going to put on a trade here, what might that look like? Well, one idea is to play both sides. You could buy the stock because you believe in the long-term turnaround story. But since the next quarter or two could still be a little bumpy, you could hedge that bet by buying some short-term put options. Think of puts as insurance. If the next earnings report is a disaster and the stock drops, the puts can help protect your investment. It lets you capture that long-term potential while managing the short-term risk.
And of course, we have to say it. This is not financial advice.